Hello everyone, thank you for joining us today for the Net Wealth Portfolio Construction webinar series. I hope everyone is safe and doing well. My name is Josh from the Net Wealth Marketing team, and today I'm joined by Michael Elsworth, the Executive Manager of Lonsec. Today's webinar is titled Retirement Income Strategies During Volatile and Uncertain Markets, and what Michael will be discussing includes his investment philosophy and process, a framework for building retirement portfolios. He'll touch on portfolio construction and more. Just before we launch into Michael's presentation, there's a few housekeeping items which I would like to cover. For the advisors listening today, one CPD point has been allocated for this webinar. You'll receive this CPD point in the follow-up email, as you usually do. This webinar is being recorded and will provide a recording, any additional resources, the slides, and the CPD point information in a follow-up email either Friday or Monday morning. If you have any questions throughout today's presentation, make sure you enter them via the GoToWebinar question panel here, and we'll answer them at the end of today's presentation. Typically, we leave about 10 to 15 minutes at the end to answer any questions. If we don't get to answer your question, I'll make sure that I pass them on to Michael and his team to follow up after the presentation. And remember, if you're liking the content which we are presenting on and sharing, make sure you share it to your social media channels and to your connections as well. A little about Net Wealth. If you're not familiar with us, we are an ASX listed company who provide a range of investment and superannuation solutions via our online platform. This includes an extensive range of investment options, including 300 plus managed funds, easy to use online research tools, and best-in-class technology. Some of our key features of our platform include the ability to buy, sell, track super and non-super investments in one place. We offer powerful reporting charts and tools, and also quite useful investment research tools for both ASX, the US, and managed funds. We've also recently started recording a new podcast series under the Portfolio Construction podcast banner. We're calling it our weekly update on the impact of COVID-19 on the financial markets. And essentially the goal of this podcast series is to interview fund managers and provide investors with timely, useful information about COVID-19, what's happening in the market, sharing any research, and also commentary which they'd like to provide. Our latest episode was with Roger Montgomery from Montgomery Investments. We recorded that yesterday, and I believe it will be live on our website later today. So if you're a fan of Roger's and you're liking the sort of content he shares, make sure you check that out. Our podcast series is also live on Apple, Spotify, Google, and Stitcher. Okay, so let's meet today's speaker, Michael Elsworth, Executive Director of Lonsec. So Michael joined the Lonsec research team in 2006 and had the overall responsibility for sectors including structured, exchange-traded products, fixed income, and alternatives. From there, he moved to Lonsec's investment consulting team as Executive Manager and now provides advice and input into model portfolio construction and allocation decisions. Prior to working at Lonsec, Michael spent 10 years at Westpac, working in a number of senior roles in capital markets and structured investments. With that said, I'd now like to hand over to Michael to deliver today's presentation.
Thanks, Josh. Good afternoon and welcome, everyone. I hope this webinar finds you and your families well in what are very strange and challenging circumstances. Let's see if these slides work. Well, what I thought I'd like to do in terms of just starting off would be to describe what our investment philosophy process is, as far as how we, certainly as far as how we think about retirement portfolios are concerned. So firstly, we take a diversified portfolio approach, and that's both across asset classes and also strategies. We have a top-down and bottom-up investment process. So we start with a strategic asset allocation, so nothing unusual there, which relies on various capital markets assumptions. And the bottom-up research comes from our 30-strong research analyst team who conduct manager reviews throughout the year. There's also a very strong focus on risk management. And this is based on investors being more sensitive to losses than gains. And there's a number of studies that support that contention. And this loss aversion certainly increases enormously as investors get older. So that can also be shown on this diagram here. So what we seek to do is really as far as possible to try and smooth out the peaks and troughs, or the highs and lows, and produce returns that are more consistent with the green line on this diagram. So in a raging bull market, the portfolios will tend to lag, but in severe downturns, we don't participate fully in any sell-offs. So that's what we're trying to achieve there. As far as a framework for building retirement portfolios is concerned, we really start with dual objectives. There's a growth objective and an income objective. Income may be fairly obvious. Many retirees look to maintain their pre-retirement lifestyle, or at least generate, sustainable levels of income. But, the focus on growth may be somewhat less obvious. We do that for, longevity purposes. Obviously, the people are living longer, and there's a greater risk of outliving savings. But also, people, retirees may be motivated by wanting to leave bequest some of their wealth. And also in a low interest rate environment, which we have certainly at the moment, when growth assets can also provide a higher capital base from which to supplement income needs. Risks are also magnified in the drawdown phase, where retirees don't necessarily have the benefit of time on their sides. So some risks are fairly obvious, like market risk and inflation risk, even longevity risk, or the risk of outliving savings. And recently, I noted that the National Seniors Australia found that 60% of 50 to 70-year-olds fear running out of money. So I'm sure that's probably something that's not a surprise to many of you. There's also sequencing risk. I won't mention sequencing risk a few times, but it really refers to the order in which returns are achieved from an investment portfolio, and how the order of returns impacts a portfolio can differ greatly between an accumulation portfolio that with no drawdowns versus a retirement portfolio with regular drawdowns to meet income needs. So negative returns, particularly early in retirement, can certainly have a devastating impact and reduce investment balances very, very quickly due to the crystallisation of losses. So therefore, we think it's very important to ensure retirement portfolios are very well diversified, not just by asset class, but also by function. And in terms of function, what I mean there is we start with portfolio building blocks, and we also have very different portfolios for accumulation and retirement. In accumulation, it's really, we classify funds as either producing alpha, beta, or risk control. And for retirement portfolios, it's growth, yield, and risk control. Let me just explain a little bit about each of those as far as the retirement portfolios are concerned. For growth, mentioned earlier, still we think it's very important, particularly for early retirees, where you're really talking about timeframes of at least 20 years or so. For yield, now yield might be fairly obvious why to focus on yield funds, but we use equity income funds to generate a lot of the portfolio income. And given where interest rates are around the world currently, it is necessary to take some equity risk in order to generate income. So there is a trade-off. Okay, and I should mention also that our retirement portfolios have an income target of 4% per annum. Yeah, it's certainly, given where government bonds are at the moment, it's impossible, I would say at the moment, to generate that income target from traditional kind of fixed income products. So some of the equity products that I'm talking about, or the equity income products that I'm referring to, are the Plato Australian Shares Income Fund. Now that's a fund that has been specifically designed to be tax effective in the hands of 0% tax rate payers by capturing franking credits. So that's a very good fit for the portfolios. Other income funds use options to time their entry and exit into stocks, such as the Talaria Global Equity Fund. And so funds like that tend to run a market of exposure less than 100%. So they won't sell off. They generally don't sell off as far as the market in markets that we've just experienced through March. And these funds typically generate the bulk of the income and have paid very high distributions over the last several years. They compensate for the low levels of income that are paid by traditional income funds. Now, just on traditional income funds, we've always maintained a healthy allocation to duration style funds, and they've served the portfolios very well over a long period of time now. But there is legitimate debate around whether fixed income funds will be able to provide that same level of diversification and that lack of correlation to equity markets that they have been able to do in the past. So we've made some changes and some tweaks to the rest of the yield component of the portfolios, and namely tried to introduce some more relative value style strategies. And we also think now is a good opportunity to seriously have a look at the investment grade credit markets and also the senior secured loan markets as well. The spreads in those markets have been very, very tight for a number of years, but they've certainly moved out significantly with what's happened in the markets during March. So that certainly will be a focus going forward. And lastly, risk control funds. Now, these play a very, very important role in the portfolios. But as I mentioned, they tend to smooth out the peaks and troughs. And a good example is a managed volatility fund, which we allocate to, which seeks to capture only 80% of the upside of equity markets, but also only 50% of the downside. So 80% of the upside, 50% of the downside. So a really good skew in terms of returns, and again, a nice fit for the portfolios here. When we're looking at the retirement portfolios, we believe a far more objectives-based approach is required than in accumulation. So specifically, for most retirees, a sustainable level of income is going to be critical, not necessarily outperforming some market cap weighted index. And management of drawdowns is also going to be critical as well, given the timeframes involved. Retirees don't necessarily have the luxury of time on their side to repair the damage done to the household balance sheet after sharp equity market sell-offs. Retirees also crave certainty. So we think where possible, portfolios should look to include products which provide an element of certainty. There is ample evidence that if left to their own devices, retirees will, they'll try and self-insure against things like longevity risk by withdrawing the minimum amounts from their account-based pensions. And we don't necessarily think that that is an optimal outcome. So in short, we think retirement portfolios need to be managed differently to accumulation portfolios. We believe there are different risks that need to be mitigated. So, for example, the risk that the income levels may fall, as has happened with term deposits over the last several years. So if retirees have had that as a central part of their retirement strategy, rolling over term deposits, they would be acutely aware of the risk involved there. There's the risk that income may not keep pace with inflation, and there's the risk that income may be volatile, which is obviously far from ideal, as liabilities in retirement will tend to be increasing steadily. Okay, so just from a portfolio construction point of view, we believe retirement products, and I'll get on to some retirement products in a moment. We believe retirement products can be used with the age pension and account-based pensions or market-linked investments to produce an income profile that looks like the right-hand side of this diagram here. So in this example, the age pension and retirement products are used to satisfy the essential spending needs, while the account-based pension is used for more discretionary needs and lifestyle goals. And again, given the complexity of what we're talking about here and some of these issues involved, we see the need for advice being absolutely critical. So the rest of the webinar, I wanted to focus on dedicated retirement products. I think it's fair to say that the investment landscape is very much caters very well for the accumulation part of the investment puzzle, but there's much less in the way of what I'd call dedicated retirement products. So we think it's great that it's receiving more attention at the moment. So I wanted to cover off two products in the market at present. First, the annuities, which have changed a lot since they first appeared some time ago, and also Future Safe, which is offered by Allianz Retire Plus. Okay. Now, there's no, in terms of allocating to these types of products, there's no single approach. So what I've got here is, in the first column, I've just showed a typical 60/40 portfolio with no allocation to retirement products. In the second column, there's an allocation to a 30% allocation to a retirement product funded from the defensive assets. So basically taken from fixed interest there, which is wound back from 35 to 5% allocation. And in the third column, there's a 30% allocation to a retirement product, which is basically prorated across all asset classes. So look, there's different approaches you can certainly take there. And just a couple of examples. In the first example, now this is an example of an annuity, and it's basically shows a couple. They're both aged 65. They've got 550,000, which is held in super, and 70,000 in other assets. So they are entitled to a part. And there's a 50-50 defensive growth split here. Now, there are various, and the other things, they want to draw an income of approximately $60,000 per annum. Now, there are various assumptions that are made as far as asset class returns are concerned, and which I won't bother running through, other than to say that they're probably a little bit dated now, and they look a little bit generous, if anything. If they were adjusted down, these account-based pension numbers probably wouldn't last that long. So, what the chart actually shows is this couple receiving the pension, the age pension in blue. In green is their account-based pension, which is paid, and also the other income from their other assets as well. And yeah, it basically shows that the couple, basically the money extinguishes from their account-based pension prior to their life expectancy, which is 93 years, and mark that red line there. So just having a look, if the couple then made an allocation to an annuity, which appears as orange on this chart, you can see that a 30% allocation made to an annuity. The assets now last beyond life expectancy, and the lifetime annuity payments, supplement or continue on, obviously paid for, and supplement any age pension payments. So this is just one example, obviously, but there are some very good online tools that can be used to model any circumstances and assumptions you care to make. Okay, in terms of the next example, this is FutureSafe, which is, for those that are not aware, which is offered by Allianz Retire Plus. It's basically a product that's designed to primarily mitigate sequencing risk by introducing a floor on a portion of portfolio returns. So in a market like we have at present, an investor can protect their portfolio downside in return for capping some of the upside. So in this particular product, investors choose from, there's a choice of Australian or global equities exposure. Income is paid on an annual basis, and exposure is reset. It's going to be reset at the end of each year. It's a 7-year product, I should say. So if you think about a normal distribution of returns or a bell-shaped curve with most returns around the middle or the average and fewer extreme positive or negative outcomes. And what an allocation to future safe produces is basically a more concentrated distribution of returns. So you get less extreme positive or negative outcomes. And importantly, this means that the chances of major negative returns are, can be significantly reduced, which is very important, particularly leading up to or early on in retirement, where investment balances are typically their highest. So this really helps to address the sequencing risk that retirees face. Okay, so why would you use these products? I suppose it really is about risk mitigation. In terms of, now some of these risks I mentioned apply to annuities, some apply to the future safe product, which I've mentioned. Look, in terms of sequencing risk, future safe, it's a significant issue, or can be a significant issue, sequencing risk, and the product is particularly targeted at that period leading up to and early on in retirement, certainly reducing that risk. Annuities, or certainly lifetime annuities, I should say, they pay an income for life. So, they help address that major concern that retirees have, which is outliving their savings. In terms of market risk, there is a need to take risk to achieve retirement goals, but it is important to do so in a risk-controlled manner. And some of these retirement products certainly help address that market risk. Inflation risk, it's very important for retirees to maintain the purchasing power of their money, and certainly most cannot afford to suffer any deterioration. And interest rate risk. For many certainly those rolling over term deposits mentioned before, they'll be acutely aware of this risk and have seen their returns diminish over the last several years. But now there's certainly a sting in the tail now. If interest rates start to rise, then traditional fixed income funds, may cease to provide that ballast type of role that they have previously in portfolios. I'll just finish off with some advantages and disadvantages of retirement products that I've mentioned. Now, some of these advantages apply specifically to annuities and some to, and others to but in terms of advantages, certainly as far as annuities are concerned, they provide guaranteed payments. In terms of lifetime annuities, they provide a payment over an annuitant's lifetime, which are contractual obligations of the life insurance companies. So the capital's pooled and monitored by APRA. In terms of downside protection, the future safe product protects against equity market volatility, when you need it. That's typically when investment balances are at their highest. And both products provide a lot of flexibility, and flexibility in terms of investors can select whether or not they want an inflation-linked index or an indexed annuity, which helps preserve purchasing power. There's a choice of underlying markets in the case of future safe. You can choose Aussie equity markets or global equity markets. Liquidity certainly has previously been a concern with some of these types of products. There's certainly enhanced liquidity with with these products. There's certainly guaranteed withdrawal periods. And there's also guaranteed death benefits for beneficiaries, which is certainly has been a concern of some of these products in the past. Okay, so in terms of disadvantages, to balance things out, opportunity cost, I would say retirees, any sort of investment involves foregoing the opportunity to potentially earn better returns elsewhere. That's, as I say, that's true of any investment. Liquidity risk, it wouldn't these daily liquid products, but you don't go into them with that sort of frame of mind. That said, there certainly are liquidity features built into these products that allow access to investors' access to the capital. There's credit risk in the case of annuitants being exposed to the creditworthiness of the insurer. But as I mentioned earlier, the life insurers are monitored, certainly monitored very, very closely by APRA. And lastly, just in terms of transparency, fees may not be quoted. Fees may not be quoted as an explicit cost, certainly in the case of annuities. Instead, annuity providers typically earn a spread between the return on assets and the guaranteed income stream paid to investors, similar to the way banks don't charge a fee for term deposits. So hopefully that has provided some understanding about how we think about putting retirement portfolios together, and also our thoughts on dedicated retirement products. Now I think it's time for Q&A, so I'll hand back to Josh.
Yep, excellent. Thank you very much for that presentation, Michael. I do have some questions that came through while you were talking, and if anyone still wanted to ask a question, please do so now. We'll try to cover as much as we can. I might just flick back to your earlier slides there, Michael. I know in the very beginning you were talking about a couple of different income funds. I believe a few people in the audience missed the names of those funds.
Sorry, which funds in particular? The income funds?
Yeah, I believe it was there was a couple of income funds that were mentioned earlier on in your presentation.
Yeah, sure. Well, certainly, and how we go about using those funds within portfolios. Yeah, look, as I mentioned, there's a couple of things. There's certainly a trade-off involved with using equity income funds to generate income for retirees. If you go back sort of 10 years or so, when interest rates were a lot higher, you could rely on traditional fixed income funds to a far greater extent. Now, with central banks kind of driving interest rates to pretty much to zero, and certainly in the case of the RBA, the cash rate's at 0.25. They've targeted pretty much everything out to 3 years at 0.25. It's very, very difficult to obviously generate any sort of meaningful income. So there is a trade-off involved in allocating to equity income style funds. And yeah, look, there's 3 or 4 that we do allocate to. What I mentioned was the Talaria fund, which is a global equity fund that uses options to time entry and exit points. And Plato's another one, which is an Aussie share fund. They do have a global version as well. But yeah, that's targeted particularly at 0% tax rate payers. So we think it's a very nice fit for these portfolios. There's also the Investors Mutual Equity Income Fund. And there's the Grand Sentinel, the Epic Shareholder Yield Fund, which again is a focused on global equities and allocates a lot to typically equities that display good defensive characteristics and so forth. That said, the COVID-19 crisis hasn't spared a lot of industries, and traditionally safer style assets, such as REITs and even infrastructure, they've certainly suffered some significant losses in March as well. So pretty much everything has been being affected. So yeah, it's typically why in that yield part of the portfolio we allocate part to equity income style funds and partly to more fixed income style funds as well.
Okay, thank you very much. I hope that answers that question. I have another one about the modeling tools that you mentioned that are available. The question was, what modeling tools are available for evaluating retirement portfolios and presenting these to retiree clients who may not understand reducing the range of distributions?
Yeah. Okay. So the several different types of models available. Some internal, some external. The ones I've used for those annuity diagrams there, they are provided by Challenger. They have some extensive and very what I'd call user-friendly modelling tools that are available. You just basically input your assumptions and about various asset class returns and so forth, desired or target income, etc., and they will be able to produce charts which can be pretty easily interpreted. For the other product that I mentioned, FutureSafe, we've certainly used internal tools basically around simulations, essentially multiple. We've run a number of different simulations. I think it was 10,000 different simulations to try and understand the behaviour of certain portfolios under different circumstances, and that's how we can produce one of those bell-shaped curves and make certainly make some interpretations of the outcomes, and therefore certainly take some great comfort in the way that the way that product will work within a portfolio, be it a balanced portfolio or a growth portfolio. Again, you can make a number of different assumptions. Again, FutureSafe will have their own modelling tools available as well, where you can plug in assumptions.
Excellent, thank you. Okay, the next question. Apart from super accounts, are there any of these products that you can engage outside of super, post-income tax, before retirement, to start planning or investing for retirement?
Yes, so I believe both products are available for within super, and without, can sit within or outside of super. So I think that's, there's certainly some flexibility from that point of view. I'm not sure whether that answers your question, but.
Okay. I will be providing Michael a copy of all the questions asked today, and perhaps that his team can follow up and provide full answers where necessary. Okay, I have a question around the Australian market. How does the Australian market compare to other countries that may have more experience or commitment to annuities and similar products?
There's certainly, from a superannuation point of view, our market is regarded as, and these are some general comments, our market is regarded as being very sophisticated in terms of its development. There's no real consistency across markets. There's a whole different approach taken. Some are certainly still have elements of defined benefits. Ours, obviously, we've moved more to more of a defined contribution type of system. And as far as products go, or retirement products are concerned specifically, look, I'm certainly not an expert on what's available elsewhere. Certainly, the annuity markets are more developed in other parts of the world. That is, I think, a function of the investor markets there being probably what I'd say more comfortable with a higher fixed income allocation traditionally. In Australia, return or portfolios more generally have a much higher allocation to equities than they do fixed income in other parts of the world. So I think that's those types of products that's provided potentially a bit more impetus for those development of those types of products. But every market at the moment is, I would say, challenged in terms of coming up with suitable retirement products, given that a significant part of the equation is very, very challenging at the moment. And I refer to fixed income markets specifically because rates are very low globally. I think the reasons for that are sort of well understood, but what it does mean, it means it's very, very challenging in terms of the types of, and it certainly impacts the types of retirement products that are being brought to market.
Thank you. And we'll perhaps answer one more question. Perhaps this is actually linked to your last response. So given the uncertainty at the moment and the strategies that you've mentioned throughout your presentation, does this mean that retirees should not change their growth allocation?
I wouldn't, it's hard to generalize with a response, but what I would say is the way we kind of approach it is for our retirement portfolios, we have 3 different risk profiles. They, conservative, balanced and growth, and they loosely equate to early retirees, late retirees, and somewhere in the middle. And, from an asset allocation point of view, they, they're typical kind of, they're 40-60, 60-40, 80-20 type, from an asset allocation point of view. So we still think there's scope for that natural sort of, progression from one, risk portfolio to another. But look, it is very much, that said, the way we tend to think about retirement portfolios is very much more from an objectives-based viewpoint. And so it, without meaning to sound kind of trite, but it really does depend on the individual. And, it is certainly kind of, hard to generalise.
Yep, sure, understand that. Well, thank you very much. As I mentioned, listeners, I will package all of the questions that were asked today and pass those over to Michael and his team to respond to you in the coming weeks. We did have a lot of questions come through, and we'd love to answer them all. We simply don't have the time, and perhaps an email or a personal follow-up will do your question a little bit more justice. Okay, well, thank you very much for joining us today. As I mentioned at the beginning of our webinar, all of today's slides and webinar recording will be provided to you in a post webinar email, either on Friday or Monday, so keep a lookout for that. I've also asked Michael and his team to share any additional research, case studies to help further drive home his presentation. For the financial advisors, your CPD points will be provided in that follow-up email, so keep a lookout for that. If you do have any questions about today's presentation, or you don't receive the webinar slide CPD points, please reach out to marketing@netwealth.com.au. If you are interested, make sure you check out our new Portfolio Construction podcast series. As I mentioned, we're recording every Tuesday with a different fund manager, and we're looking at the impacts COVID-19 is having on the financial markets. We have 2 episodes published at the moment, one with Sebastian Mullins from Schroders and the other with Roger Montgomery from Montgomery Investments. That podcast is available on all of the popular podcast channels. And finally, with current situation, everyone working from home and especially schools and universities being run remotely, virtually now, it might be a good time to have a look at Banker. Banker is our is a product that we champion. It's a virtual financial literacy tool, which is essentially a virtual economy. Kids can go on and learn accounts, investments, budgeting, etc. It's quite a unique piece of software. There's a stack of students using it at the moment, and now might be the perfect time to brush up on your financial literacy. Well, once again, thank you very much to Michael for joining us today. Thank you very much for listening in, and we'll see you next week. Thank you very much.